Alrighty, what is going on, everybody? Welcome back to another CYPRX video fundamental update. In today's video, we're just going to pick up where we left off in previous video breakdowns, explaining to you all why for the entire month of June, we predominantly saw a risk-off market sentiment and a decline in the total valuation of the crypto market class as a whole. Not specifically covering any one digital asset, but zooming out and looking at the total market cap for crypto as a whole. Many blessings to you guys. Welcome back to the CYPRX platform, accurately giving you guys these updates and fundamental breakdowns. If you enjoy these videos, do us a favor, smash that thumbs up button and subscribe. So again, picking up from where we left off, you can see here is a video clip from May 23rd, 2024, over a month ago, where we accurately called this pullback in the total cryptocurrency market cap, where we topped out at roughly around 2.58 trillion and started our decline. Now, in this particular video breakdown labeled Crypto Explosion that was uploaded 9 days ago to the YouTube, we went into detail explaining and picking apart the markets, why we saw stronger dollar the month of June, and a pullback in risk assets as a whole. Now, most recently on the X space, we gave you guys a fundamental market recap explaining why last week the total cryptocurrency market cap lost over $200 billion, starting the week off at $2.2 trillion and ending the week at a staggering $1.98 trillion. This was primarily due to investors seeking refuge out of a declining United States dollars because of some dwindling US economic activity that we saw, where we saw economic data from last week indicate slight cooling in the US economy, where both sets of PMI figures and manufacturing services showed signs of contraction and economic slowdown. We additionally saw that there was a decline in ADP non-farm employment change and an increase in unemployment claims, as well as a rise in unemployment rates and also a slight decline in average hourly earnings. This overall created less of a demand for the United States dollar and more of a demand for other major G10 currencies and gold, which we saw reflected in the rise in the value of the Great British Pound, the euro, and gold last week. Now, usually when we see a decline in the strength of the United States dollar, we tend to see an appreciation in risk assets, particularly in crypto. However, last week we saw that Mt. Gox announced that it had begun repayments to customers, ending a nearly 10-year wait for some users to recover their crypto after a 2014 hack that led to the exchange's bankruptcy. So overall, this announcement heightened selling pressure on Bitcoin and the broader cryptocurrency market, which contributed to the skepticism despite the dollar's weakness that we saw last week, which tends to create a favorable environment for risk asset investors, as we saw reflected in the Great British Pound strength and the Euro strength last week. But instead, because of that Bitcoin release into the market from Mt. Gox, we saw sell pressure on risk assets like crypto all across the board, where again, the total cryptocurrency market cap lost over $200 billion in value. Moving on this week, we have some key economic data to be paying attention to. Again, on the X space, you guys have a full market update as to what fundamentals you should be paying attention to moving forward, heading into tomorrow and Friday this week. So tomorrow, our primary focus for market sentiment will be on the CPI figures, both month over month and year over year. Last month, we observed continued disinflation. So for weaker dollar, we ideally need to see this disinflation trend persist, which would keep rate cut bets on the table, that we know rate cut bets tend to boost optimism and strength in risk assets, hoping for a potential rate cut in September. Currently, the market projects that inflation will neither rise nor decline in this up-and-coming CPI report. Since the data projects no relative change, any significant deviation from the market expectation will likely create one-sided volatility in the dollar and assets traded against it, which we'll go over in today's video breakdown. So let's discuss the possible scenarios. We'll cover the most favorable scenario first, which will be scenario number 2. That would be lower than expected CPI. As risk asset investors, we hope to see disinflation continue, with CPI month over month and year over year beating the market forecasts and coming out below the previous readings. This would likely prompt optimism that the Fed will start to cut rates in September, sparking more demand, most likely for risk assets in gold, while reducing demand in the dollar. This scenario would likely lead to the dollar breaking below the key psychological level of 105, which I'll show you all is an important psychological level, heading towards the mid or low 104s. Lower CPI readings would suggest easing inflation, encouraging the Fed to possibly cut rates in 2024, which typically creates a low interest rate environment. And we know a low interest rate environment tends to favor risk assets and reduce the demand for the dollar. So, with that being said, let me share my screen with you guys and walk you through what that scenario would likely look like on the total cryptocurrency market cap as a whole. So, heading over to the total cryptocurrency market cap, given the scenario number 2, which is where we would see lower inflation readings both month over month and year over year, you can see here the inflation rate month over month for the CPI reading is set to come out at the 0.2% mark, which is the same as the previous reading. And you can see the core inflation rate year over year is set to come out same as previous. Here's the forecast, and the previous reading was 3.4%. So in scenario number 2, we would ideally like to see inflation readings drop below 0.2% month over month and below 0.34% year over year to see further weakness of the dollar, a rebound and a recovery in risk asset strength like the total cryptocurrency market cap, and a favorable risk on market environment. So in a scenario where that plays out, most likely what is going to happen is we are going to hold these previous demand ranges that were created mid-February, holding above the $2 trillion mark in the total cryptocurrency market, start to triple bottom out here and start to correct some of this previous downside move from last week. In a scenario like this that unfolds, how that would most likely reflect in the strength of the dollar is we would most likely break back beneath the 105 key psychological level that is currently holding the DXY strength as of time of recording this video breakdown, and start to see a market decline in the strength of the United States dollar below the 105 key psychological level, correcting some of this previous bullish move. Now, keep in mind, I want to show you all something very important because we are at a key psychological level with the total cryptocurrency market cap over here on the left-hand side and the DXY, i.e. the strength of the United States dollar on the right-hand side. And what I want you all to pay attention to is over here towards the end of February, you can see that prices consolidated before expanding up through $2 trillion and hitting all the way, peaking at roughly about $2.7 trillion in total market cap valuation. Significantly enough, when the market was hovering around this $2 trillion to roughly around $1.98 trillion mark, that is exactly where the DXY was at when it started to decline in value. You can see right here that the DXY was roughly tapping into the 105 key psychological level before it started its decline. Was at the same exact time that the total cryptocurrency market cap was hovering at about 1.98 trillion before it smoothly transitioned through $2 trillion and started its incline. So keep that in mind that ideally, in order for us to see a recovery in risk asset strength, i.e. a bullish scenario in the total cryptocurrency market cap, we would ideally like the United States dollar strength to dip beneath the 105 key psychological level, further correcting more of this previous bullish move. That would most likely lead to a bullish recovery in the total cryptocurrency market cap valuation, in my personal opinion, right? Now let's go over scenario number 1. Scenario number 1 would be if we see higher than expected CPI. That is, if inflation comes out higher than market analysts are expecting, indicating that inflation is still sticky and troublesome. This scenario would likely push back rate cut bets, with the market starting to price in higher for longer interest rates or even potential rate hikes, as many Fed speakers have suggested is possible if disinflation does not continue. This outcome will likely lead to a stronger dollar scenario, holding firm above the key 105 psychological level and correcting last week's sell pressure on the dollar that we saw due to the dwindling economic activity on the US front. A higher CPI report would suggest persistent inflation and prompt the Fed to maintain or possibly even consider increasing interest rates to curb inflation, thereby leading to further strength in the dollar. So in a scenario where we see that unfold, most likely what we are going to experience is the DXY holding above the key psychological level of the 105 and starting to correct some of this previous downside move from last week. Give or take, looking something like this after some liquidity grabs beneath lows, breaking back above the key 105 psychological level and making its way back up into the high 105s, again correcting some of this previous downside move from last week. How that would correlate if we see stronger dollar tomorrow, driven by higher inflation readings, pushing back rate cut hopes, and the total cryptocurrency market cap reflection of price, that's most likely going to look something like this: a failure to hold above the $2 trillion mark, failure to create bullish order flow, and we're most likely going to start to see a further market dump to come and target these previous lows from back towards the end of February, roughly around the $1.9 to $1.8 trillion mark. I could see that if we do not continue with any bullish momentum, we do not see a risk on market mood, we see higher inflation readings leading to stronger dollar, we're most likely going to come and attack these most recent lows, leading down into the areas of interest of demand from back towards the end of February 2024, possibly even heading down towards $1.8 trillion. Again, that would just coincide with the most recent market downturn and trend continuation to the downside that we have most recently experienced. In a scenario like this, zooming out, I want to keep you guys forward looking. Keep in mind the massive expansion that we saw in February from roughly around $1.5 trillion all the way up to $2.7 trillion. This most recent market downturn that we've just witnessed, in my personal opinion, is still a healthy pullback as long as the total cryptocurrency market cap can hold above $1.5 trillion. Reason being is because, again, market corrections in order for price to accumulate more orders and go higher is extremely healthy. Looking out, taking our Fibonacci and drawing it from the bottom of price action all the way up to the high that was created after the February rally, you can see that currently we are only at a 66% discount from where prices were via the total cryptocurrency market cap at the very beginning of this year. So even if the market did drop down into 1.8 to $1.5 trillion, that would still be a healthy correction to zoom out and see the total cryptocurrency market cap start to accumulate more orders here in this area and then flip back bullish, continuing the overall market trend that we've seen since pretty much the end of 2023 heading into this year, right? So again, just keep that in mind. If we do see another or continued market downturn, sells on risk assets across the board led by strength in the dollar, as long as we are above the 2024 lows on the total cryptocurrency market cap at roughly around $1.5 trillion, I'm going to continue to maintain my bullish bias, zooming out on the higher time frame and seeing that this most recent market correction, in my personal opinion, is just a healthy market correction for market makers to come and accumulate discounted orders from where prices were at the beginning of 2024. With that being said, go check us out over on X so you all can read these full fundamental breakdowns and stay up to date with these market dynamics. As you guys can see, accurately calling out this most recent market pullback, give or take the fundamental environment that was created in June. It was very easy to analyze this. Moving forward, we now know what we need to see in order to see a risk on market sentiment. Hopefully that's the sentiment that we get over the next 2 days, considering the important inflation data, both in CPI figures and PPI figures that are set to come out over the next 48 hours. Many blessings to you guys, and make sure that you're paying attention to detail. With that being said, as always, be cognizant, be aware out there, and I'll see you all in the next video breakdown.